One, understanding business finance, the lifeblood of organizations. Business finance is not merely the act of obtaining funds, it is the totality of planning, managing, controlling, and evaluating the financial activities of an enterprise. It involves resource mobilization, resource allocation, risk management, and performance monitoring. Definition: business finance is the application of financial principles to strategic and operational decision-making in a business context, aiming to ensure solvency, profitability, and sustainable value creation. Analogy: if a business is the body, finance is its circulatory system, ensuring capital, blood, is continuously supplied to all vital functions like production, marketing, HR, and innovation. 2. Historical evolution of business finance. The financial function has undergone major transformations, evolving from transactional to strategic. Era, focus, key characteristics: pre-industrial wealth preservation, barter system, personal financing, merchant banking, industrial revolution, capital raising, shareholding, banking institutions, large-scale manufacturing, 20th century control, and analysis, standardized accounting, capital budgeting, investment science, modern-day strategic finance, financial planning, corporate governance, fintech, ESG, modern role. Finance today is predictive and strategic, involving AI, data analytics, sustainable investing, and global capital markets. 3 objectives of financial management profitability. Objective: ensure that operations generate sufficient returns for stakeholders. Liquidity. Objective: maintain the ability to meet short-term obligations and avoid cash crunches. Wealth maximization. Optimize shareholder value by enhancing share price and dividend yield. Risk-return balance. Identify and manage the risk exposure of investments and financing decisions. Sustainable value creation. Align financial goals with long-term environmental and societal well-being. Critical insight. A narrow focus on profits can harm long-term growth. Advanced finance emphasizes economic value added, EVA, and sustainable growth over mere accounting profits. 4. Scope and domains of business finance. 1. Investment, capital budgeting, analyzing and selecting long-term investment opportunities using methods like net present value, NPV, and internal rate of return, IRR. 2. Financing decisions, choosing between debt and equity, structuring the capital mix, managing cost of capital. 3. Dividend decisions, determining the payout ratio, reinvestment of earnings, signaling effect of dividends. 4. Working capital management, optimizing day-to-day finances, cash, inventory, accounts receivable/payable. 5. Strategic financial planning, setting long-term goals, forecasting capital needs, and defining growth strategies. 6. Financial risk management, using derivatives, insurance, and diversification to shield the business from uncertainties. 5. Fundamental principles of business finance. Time value of money, TVM. A naira today is more valuable than the same naira in the scope and domains of business finance. 1. Investment, capital budgeting. Analyzing and selecting long-term investment opportunities using methods like net present value, NPV, and internal rate of return, IRR. 2. Financing decisions, choosing between debt and equity, structuring the capital mix, managing cost of capital. 3. Dividend decisions, determining the payout ratio, reinvestment of earnings, signaling effect of dividends. 4. Working capital management, optimizing day-to-day finances, cash, inventory, accounts receivable/payable. 5. Strategic financial planning, setting long-term goals, forecasting capital needs, and defining growth strategies. 6. Financial risk management, using derivatives, insurance, and diversification to shield the business from uncertainties. You're due to its earning potential. Example, 100,000 naira invested today at 10% will be worth 110,000 naira in 1 year. Risk-return trade-off. Higher returns usually come with higher risks. Example, treasury bills are low risk with low return. Stocks offer higher returns with more risk. Matching principle. Long-term assets should be financed with long-term capital and vice versa. Cash flow. Primacy. Decisions must focus on actual cash flows, not just accounting profits. Why? Profitable firms can fail if they run out of cash. Incremental analysis. Evaluate only the incremental additional costs and revenues when making decisions. Opportunity cost. Every financial decision involves a trade-off. The benefit of the next best alternative foregone is the real cost. 6. Comparing finance and accounting. In-depth. Category. Accounting finance core. Purpose record. Past transactions. Plan for future success. Main output. Financial statements. Budgets. Forecasts. Valuation orientation. Historical forward-looking decisions. Compliance and accuracy strategy and value creation tools. Used journal entries, ledgers, NPV, IRR, WACC, EVA bridge. Finance uses the raw data provided by accounting to guide decisions regarding investment, operations, and funding. 7. Strategic role of the finance function in business capital raising. Evaluating funding options, bank loans, bonds, equity, VC, and selecting based on cost, control, and risk. Budgeting and forecasting, creating financial roadmaps that guide decision-making across all departments. Investment planning, appraising opportunities and allocating resources to projects with the highest expected returns. Performance monitoring, using financial ratios and metrics to assess departments, branches, or the whole enterprise. Compliance and governance, ensuring adherence to local and international financial reporting and legal standards, e.g. IFRS, GAAP, SOX. Stakeholder communication, reporting financial health to investors, banks, regulators, and the board. Strategic leadership, CFOs today shape M&A strategy, expansion plans, market entry, and product pricing based on financial modeling. 8. Ethics and corporate governance in business finance. Key ethical dilemmas. Window dressing financial reports. Misusing insider information. Misreporting profit to attract investment. Ethical frameworks. Transparency. Clear disclosures. Fairness. Avoiding biased financial practices. Responsibility. Protecting investors and the public interest. Accountability. Internal controls and audit trails. Corporate governance pillars. Board oversight. Separation of ownership and control. Internal audit systems. External auditing. Whistleblower policies. ESG finance. Environmental, social, governance. Advanced business finance now integrates ESG metrics into decision-making, evaluating not just financial ROI, but societal and environmental impact.